right? So looking at the income statement and the statement of financial position may not give you enough information to be able to adequately or accurately analyze the performance of a business. And so accounting ratios become very important. And you need to know how to calculate these ratios and also how to interpret these ratios, right? Because as you can see from the question that we will be looking at today, right, you will be required to know how to analyze and interpret the ratios, right? So if you haven't watched the video on ratio analysis as yet, you can go back and watch it afterwards. All right. So let's look at this question. It says Lodenki, Mart, and Budai Mart both trade in ladies and children's clothing. Their financial statements at December 31, 2008 shows the following. And so we get their financial statements, right? It looks like it's a balance sheet, and they give us some information from the income statement, like opening inventory, sales, purchases. Right? Those would be from the income statement. Then they said the first one is to calculate the following ratios for both businesses. And as you can see, I have the names of both businesses there, and I'm going to now calculate the ratios. Now, whenever you are calculating ratios, it's always good. I always tell my students, it's always good to write the formula, right? So that the examiner can know that you know the formula. Because sometimes you may write a figure incorrectly, right? And when you write a figure incorrectly, the examiner, they will then assume that you just don't know or you don't understand what you're doing. But if you write the formula, the examiner can see that, okay, well, this person know or understand what the formula is about, but just may have made an error. So it's always good to write the formula first. So the first one that they want us to find is asking us to find the current ratio. The formula for the current ratio is current assets over current liabilities, right? Because this is where CSEC tries to trick you guys, right? If you look at this statement there, the current assets total is not explicitly stated. So you have to calculate it. So those four figures are what you should use. So when you use those four figures, they get 112,300 for this guy. 112,300, right? So let's calculate now the current liabilities. Current liabilities now for London Key, 33,000. Because it's only one. London Key only have one current liability, right? Let's look at Budai now. So Budai, his current assets now would be equal to 90,000, which is the inventory, right? 90,000 for inventory, 42,000 for debtors, right? The bank, if you can realize, his bank is not there. His bank is not there because it has a bank overdraft, which is a liability, right? So it's going to be plus 2,000. So it's 134,000 for Budai, for his current assets. 134,000 divided by his current liabilities. Now is creditors, which is 78,400. In today's questions, you may not see creditors, you may see accounts payable. Remember that, right? And then you have bank overdraft, which is 30,000. So it's 108,400. All right. So we got that. So now we use our calculator to calculate this. So it is 112,300 divided by 33,000 equal 3.4. 3.4 to 1. That is how you write. And for Budai, it's 134,000 divided by 108,400 equal 1.2 to 1. That is how you write, right? So that's their current ratio. The next ratio that we are asked to do, Next ratio that we are asked to do is the acid test ratio. Now the acid test ratio is the same as the current ratio. The only thing is we take out stock. So the acid test is also called the quick test. So the acid test is current assets minus stock divided by current liabilities. Right? So the acid test is 112,300 divided by 33,000. This is minus the closing stock for Ledenki is what? 70,000. And then for Budai it is 134,000 minus, and is the closing stock is 90,000 divided by 108,400. So all we need to do now is just to work that out. Get the calculators. 112,300, right, minus 70,000 equal 42,300 divided by 3,300. This is 1.3 to 1. And Lodenki now, Budai is 134,000 minus 90,000 equal 44,000 divided by 108,400, right? And that gives us 0.4. 0.421. All right. Yeah, so we're going to do the inventory turnover now. So the turnover ratio is actually cost of goods sold divided by average stock. And remember that average stock is the opening stock plus the closing stock divided by 2. So let us work on this now, because we have a lot of calculations for this one. All right. So for Lodenki now, the cost of goods sold, guys, is that figure that we would subtract, right? That figure that we would subtract from our net sales to get our gross profit, right? That is what our cost of goods sold figure is. And our cost of goods sold figure would have been our cost of goods available minus closing stock. Let me repeat that. Cost of goods sold figure, how do we get it? Cost of goods sold would be our cost of goods available minus our closing stock. That's how we get cost of goods available. You may ask, how do we get cost of goods available, right? How do we get that figure? Now, the cost of goods available is normally your opening stock plus your purchases, right? So your opening stock plus your purchases, that gives you the cost of goods available. And if you subtract your closing stock from that, you get your cost of sales or your cost of goods sold. All the information that we need to calculate cost of goods sold is right here in the question. So let us go. We are given the opening inventory for Lodenki, which is 63,000, right? So you get a calculator and you type in 63,000. What we're calculating now is we're calculating the cost of goods available. So 63,000 plus the purchases. They give us the purchases figure now. See that? 80,000, right? 80,000 equal 143,000. So for Lodenki, his cost of goods available is 143,000. Now we need to subtract our closing inventory from that, which is 70,000 minus 70,000 would give us 73,000. So Lodenki's cost of goods sold is 73,000. You guys see how I got the 73,000? Now let's do the same thing for Budai, right? Before we start with the average. So for Budai, opening inventory is 73,000. So on your calculator, you type in 73,000, 77,000. 77,000 plus your purchases 150,000 equal 227,000. That is our cost of goods available. 27,000. Right. So now we're going to subtract our closing stock for Budai, which is 90,000. Closing inventory 90,000. That gives us 137,000. Right. So that now would be our cost of goods sold. 137,000. You see how they make it difficult? Right? That's how they make it difficult, guys. Then now we have to calculate average stock, and this is another calculation again. Because now we have to now add our opening stock plus our closing stock and divide that by 2. That is how you get average stock. So for Lodenki is opening stock is 63,000 plus its closing stock, which is 70,000, equal 133,000. Then you're going to divide that now by 2. Give us 66,500. 66,500. Right. So 83,500. All right. So now, all we need to do now is to just calculate it. So 73. We're going to do Lodenki first. So 73,000 divided by 66,500. We did the calculation and we got 1.09 something, right? So we can just say 1, right? 1 time. So it would have meant that Lodenki would have bought stock 1 time. And Budai now, we calculate in Budai 137,000 divided by 83,500. That would have been 1.64. We can roll it up and just say 2 times. I mean, what is 0.6 of a time? You know what I'm saying? So we can just say 2 times. So 1 time, 2 times. So Budai bought stock 2 times, while Lodenki bought stock 1 time. Right? That tells you something about how business is going. The last ratio now is profit margin. The profit margin is the same thing as the net profit to sales ratio, right? So the formula is net profit divided by sales multiplied by 100, right? So let's look at the profit margin ratio for Lodenki now. Net profit for Lodenki is 25,700. 25,700. What is the sales figure for Lodenki? 250,000. Right? For Budai, net profit 32,300. Divided by 305,000. So that's 10.28%. And then for Budai now, it's 32,300 divided by 305. It's 10.59. Or you could say 10.6 if you want, or you could say 11, right? This could be 11. Right? So this is a profit margin ratio. So what it means is that for every $100 invested, right, for every $100 of sales rather, right, 10.28% or 10.3% is profit. And similarly for Budai, for every $100 of sales, basically 11% is profit, right? So they are not so different in terms of profitability or profit margin, right? Yeah, so this is the first part of the question that values 10 marks. All right, guys, so that was 10 marks. You see a lot of work you have to do, right? So it looks easy because it's just 4 ratios, but you have to, especially this ratio, the third one, it's very difficult to calculate because you have to calculate the cost of goods sold, plus you have to calculate the average stock, right? So I want you to pay attention to that. Now let's answer the remaining questions. So we're trying to get the remaining 10 marks, all right? So the first one, B, it says identify 2 ratios from the list above, right? 2 ratios from this, right, that can be used to assess the profitability of the business. That's easy. Which one? Excellent. Very good. Right. C now. Identify 2 ratios from the list above that can be used to assess the ability of the business to pay their debts. That's easy again. You're asking about the liquidity ratios. Excellent. Right? Very good. D now. Identify 1 ratio from the list, right, that can best test the liquidity of the business. That will be the acid test ratio, right? This would best test the liquidity of the business. And the reason for that is because with the acid test ratio, we don't have stock. Stock, right, is the least liquid current asset, while obviously, you know, cash is the most liquid, right? CE, state which business is more profitable using the appropriate ratio to support your argument, right? And you know, that's easy, right? We can state which business, we can use 2 ratios, right? Well, actually 1. So you can use the profit margin ratio to say that Budai's business is more profitable because this is actually 11%, being technical, right? This is actually 11%, while this is just 10%. You get what I'm saying? So I could just take out this, and this is 10%, and this is 11%. Right? So Budai's profit margin is greater. Also, you could say that Budai has more sales, but then more sales does not mean more profits. Right? So I want to get that. More sales does not mean more profits. And that is the reason why the profit margin ratio would have been the best ratio to use as opposed to the turnover ratio. Because more sales does not mean more profits. All right? So the answer is Budai. And the reason is because they have a higher profit margin ratio. F, state which business is in a better financial position using the appropriate ratio to support your argument. Now, the ratio that you want to use to find out if the business is in a better financial position is the current ratio. The current ratio would show the business's ability to cover their debt in the event of bankruptcy, right? I said before that a good current ratio, right, is 2 to 1 or 2.5 to 1. Anything less than 2 to 1 is not good. So with that being said, which business is in a better financial standing? Excellent. So Denki would have been in a better financial standing. And you may ask me, so sir, how you know or why you say that? Now, if you look, the current ratio is the current assets over liabilities. Remember, liabilities are not good. Not good. So if your liabilities are high, that is not a good thing. Budai's liability is very high. It's almost the same as their assets. That is why their current ratio shows 1.2 to 1, which is very bad for a current ratio. If this was an asset test ratio, it would be okay. But it's not, right? So what this basically means is that should the business go bankrupt, right, they are going to struggle to cover their current liabilities. Now, if you look at Lodenki's own, their liabilities are low. As a business person, you want to ensure that your liabilities are as low as they possibly can, right? Because you don't want it to be a case where you your liabilities and your assets are the same, then you're in a very bad standing. And as you can look, Budai's liabilities and their assets are basically the same, right? While Lodenki's assets far outweigh their liabilities, and that is the reason why their current ratio is 3.4 to 1. So if the business should go bankrupt, they can cover their current liabilities 3 times over. That is good, right? That is good, because it means that the shareholders will not have unlimited liability for those students who do POB. That's what it means, right? For these guys, chances are there may be some unlimited liability for one shareholder or some shareholders, right? So yeah, that's it. I get the 3 marks, 20 marks, easy, right? So that's accounting ratios.